Hello and welcome to the course. Hi, I'm Steve Ballinger. I'm the creator and instructor of the course and a longtime instructor here on Udemy. And I'm so glad you're with us. We're going to learn a whole bunch about investing in the stock market. We're going to do a quick little overview of the course here, and then we're going to just start diving right into it. So each section has many lessons under it, and I want you to feel comfortable that if you know a section pretty well already, or you want to skip ahead to other sections, you can certainly do that. Make the learning work the way that you want it to work for you. But it's designed that you can start at the beginning and go straight through for a good comprehensive course. So if we look at some of the different sections, we've got the first section, we're going to really talk about how the stock market works. Things like around how are prices set, supply and demand, how are, market capitalization, like large cap, small cap, middle cap stocks, and all that, kind of the whole kind of broad concepts of the foundational concepts of the stock market. Next, we're going to go into actually more evaluating stocks or evaluating companies as part of that. And I like to think of it this way, where we're kind of building up towards different things. We have a qualitative analysis where we're really looking at companies that you might want to be looking at even closer or be on your watch list, we might say. You're really evaluating the company. We'll use some tools there like SWOT analysis and Five Forces analysis, easy things so you can really kind of evaluate a company from its strategy and its tactics, maybe its vision and long-term missions. Then we're going to get into real nitty-gritty as far as evaluating the stock of a company, whether we should invest in it or not. We'll look at two big schools of thought. One is fundamental analysis, the other is technical analysis. Fundamental analysis really gets into ratios. You might have heard of things like the PE ratio or price-earnings ratio. That's fundamental analysis. So looking at this, and so we're going to walk through some of the key numbers to look through from a fundamental standpoint. Then we're going to look at technical analysis. A lot of times that's known as charting, where you're looking at indicators. You're looking at a chart and you're looking at the indicators on a chart, and that's going to tell you something, whether it's time to buy or maybe time to sell a stock. For example, like a moving average crossover is a real easy indicator to visually see, and it'll tell you, buy or sell in terms of indication or indicator. And then one thing that's real important that a lot of times gets missed in some courses, I suppose, but one thing that's real important is actually placing the actual orders when you're buying or selling stock. And when you do that, you want to do that correctly, because you could do everything else right and kind of mess it up right at the end. So setting things like a stop loss and different things that we're going to learn about towards the end of the course are very, very important as far as the order placement. And then we'll do a wrap up and next steps to wrap up the course. And as you can see on the right-hand side here, it kind of builds on itself where the qualitative is looking at what do we want to look at from a watch list standpoint, what do we want to kind of follow. Fundamentals would be like, what do we want to buy? What do we want to buy now or sell now? Technical would be like when. That gets more into timing. And then how, of course, is placing orders. And you certainly don't have to decide this now either at all, but some parts of this will resonate more with some types of traders than others. So for example, if you want to be or are a day trader where you're trading all throughout the day and you're opening and closing positions throughout the day, you're going to want to focus more on that technical analysis and placing orders part will be very, very important to you because you're making a lot of trades and that'll be very, very important to you, as you'll see going through the course. Now, if you fancy yourself, maybe you want to be a little bit more part-time trader or more of a buy and hold investor, that's where that qualitative part and the fundamental analysis might be very important too. But they all work together is the big idea here, and that you can kind of be a hybrid too, kind of like what I do, where I have some things I buy and hold for a long time, and I have other things I'm frequently trading in, and so I'm kind of using the best of the both worlds, so I can teach hopefully the best of the both worlds for you as well. A couple real quick things before we get in the course, more from a housekeeping standpoint, or some tips around getting the most out of the course. One thing is, sometimes I get excited talking about the stock market. I like to talk about it. And sometimes I talk very fast when I do that. So if you find I'm talking too fast on Udemy, it might be different places, whether you're on mobile or whatever, but there'll be a spot where it might say like 1x where you can click it, and you can change the speed and can slow me down. Maybe you can speed me up, but I'm not sure too many people speed me up. I think if anything, they slow me down. Also, you can change the video resolution if it's coming through a little choppy or anything. You're going to be able to automatically stream it at the correct resolution for your device and your Wi-Fi or whatever you might be using. But you can manually choose too on the right-hand side, like on the desktop version, there's a sprocket, and you can just change that resolution to have it come through a little better. It's all filmed in high definition, but if you're having a hard time streaming it through, that's on Udemy's end, then you can always adjust it there. Lastly, I certainly would recommend taking notes too throughout the course. That's always a good tip. I'm a big note taker, so I would certainly recommend that. Okay, so we've got a lot to learn. Feel free to go straight through or jump ahead to whatever sections that interest you, and let's start learning about how we can become better investors and traders in the stock market. One nice thing is there's a lot of free tools you can use out there to help you become a better investor and help you become a learner of the stock market as well. And one of the real most important ones is what's called paper trading. And all paper trading is basically practice, where you can practice with fake money before you start using your own real money. And paper trading, basically you can sign up for a site. I'm going to show you one that's absolutely free here in just a moment. You can get on this free site. A lot of online brokers will provide this service for free as well. But basically you get like a fake amount of money, let's say like $100,000 US, for example, and then you can buy and sell stocks and practice with that for free. You're not actually using real money, you're practicing and putting into practice some of the things you're learning in the course, for example, through this paper trading. It's a great tool to learn and to get comfortable with investing in the stock market. And you can find paper trading that works for you. Just put in wherever you live in the world, just put like paper trading for whatever, US stocks or your country name. You can find that and other free tools out there, depending where you live all over the world. I have students from all over the world, so just do simple internet searches like that and you'll be able to find these different tools. But one that I want to show you here is called TradingView, and that's pretty accessible from all over the world and actually works in a lot of different markets too, from India to United States to UK to Asia to all the markets, and you'll see how that works here in just a moment. So that's a great one to use. So let's take a look at TradingView and how you would set up your paper trading account. And you can start paper trading whenever you feel ready as you go through the course. Okay, to set up this paper trading account, I'm over here at tradingview.com. So TradingView is a good free site to use. They have lots of pop-up ads on their free version, so you've been warned there, but good place to get started. And all you do to get started is you just need to search markets, put in a company name. I just click there, and you can put in any company that interests you to just get started. I'm going to put in Dr. Reddy, or start typing that, and you'll see below how they've got these different things for Dr. Reddy Labs. They're actually a pharmaceutical company, make generic pharmaceuticals out of India. So you can see they're listed on the India Stock Exchange here, but they're also on the New York Stock Exchange as well, too. So just as a point of information, all you do is choose one of those. I'm going to choose this one. You can see I'm under India here, so this is in rupees. Just a point of information. Here's the other stock exchanges listed under. You can click on that down arrow, and I can have it in dollars, the New York Stock Exchange here very simply. Let's leave it in rupees. None of this matters yet. This is stuff you might do later on. But to set up your paper trading, you just need to get into one of them. Go to this little square here where it might say Advanced Chart or More Chart or See More Active Chart, something. There's a little square there. It'll bring up the chart for Dr. Reddy. You don't have to worry about that yet either. What you're looking for is to go down here at the bottom where it says Trading Panel. Click at the bottom here where it says Trading Panel. Different links to different panels that you can do. But here where it says Paper Trading, right down here, this is from TradingView. You just click on that, and then it'll set up your paper trading account, and you can connect and start doing paper trading just by entering in like your email or some basic information. And that's free. And you can also sign up for their site too as well, and then you can do paper trading. So you can practice things like selling or buying. You can see I can click here and say a broker isn't connected, but if my paper trading was here, then I could connect it and I could buy and sell. So that's how you set up the paper trading in TradingView. And as we go through the course, you'll learn about different things on how to use this panel, especially when we get to the technical analysis part. But you can use that to practice and play with before using real money. Some other free resources we'll use in the course that you can use as well that are good basic free resources. One is like Yahoo Finance has lots of information, especially around the stock quoting part, pretty basic, pretty easy to understand. So we'll use some of that. Investing.com is essentially the same as Yahoo Finance. They'll actually have the same types of numbers and fundamental stuff, especially that we can look up. The nice thing about Investing.com is it works really good for a lot of different places in the world because you can get at different stock markets more so than Yahoo Finance. So depending where you live, you might gravitate more towards Investing.com. And then sometimes there's different types of quote tools and things that are for free that are more country specific, depending on where you live, for example. So for example, a really good, robust one for the United States is called FinViz. It can get a little complex at times, but if you're US based, or I believe Canada work for Canada as well, North America, FinViz would be good. But otherwise, just go on the internet, do a simple internet search, stock quote or stock quote tools for your country name, and you'll find something that's more specific to you. And then everything I'm teaching here is universally can be applied. So as you learn a concept, you can use it no matter where you live, which is really a great thing. Okay, I'm sure you're eager to look at a couple stocks that might interest you right now. So I'm going to give you a couple things from fundamental and technical analysis so you can get started right away with an activity to look at stocks that might interest you. And then we're going to learn so much more, of course, going through the course. So what we'll do is I'm going to show you how to look up a couple numbers that are can be very important. One is looking at fundamental analysis. That's looking at ratios and things. So we're going to look at the price to earnings ratio, which a good price to earnings ratio is like between 13 and 15 is the average. Lower, with all these numbers, the lower the number, the better. So if it's something like 12 or 11, that means the price in relation to its earnings, for the company's earnings, is at a good value. So just for now, just think lower the number, the better with all these different fundamental ratios. So this is price comparing it, the stock price currently comparing it to its earnings that the company is generating. Another ratio that I actually like even better is what's called the PEG ratio, where it looks at the price to earnings. That's the P&E part of PEG. It's the same price to earnings ratio, but it adds in a growth factor. We're interested in investing in stocks that have growing earnings, right? So with this number, a PEG ratio, something that's less than 1.0 means it's at a very good, desirable price point in terms of being of value. That doesn't mean, like, certainly some high-end growth stocks or high fast movers will have high PEG ratios, high price to earnings ratios. That's okay. This is just a measure that we can use to see how good the price is, in comparison to the broader market, like a wider S&P 500 or the Nifty 50 from India, whatever it might be, a broader market. And for PEG, we're looking for less than 1.0. Price to sales, this is good when a company might not have earnings yet because it's a newer company or a high-tech company that's still growing and doesn't have earnings yet as far as positive earnings. You can look at their sales and how are they doing in terms of price relative to their sales. The average is about 1.162 as far as a price to sales. Ranges can be anywhere from 0.8 to 3.0 plus. For the broader, again, like an S&P 500 market, got as low as 0.8 back in the Great Recession, 2008, 2009. So you can kind of use that to compare too. But the lower the number, the better. And I'm going to show you an example, a demonstration of all this, so that way you can apply it yourself. And then technical analysis, looking at a chart, we're going to look at the moving average and looking for when it crosses over a price line. Now, that's easier to show by demonstrating. So let's take a look at an example here, and then you can do this on your own. And as you go through the course, you'll learn much more in depth, many more fundamental ratios, many more technical ratios, and all that to give you a full, complete course. So let's take a look at an example here. We're going to look at two platforms real quick here. We're going to look at finance at yahoo.com, and we're going to look at TradingView, which is really good for us if you want to be a real active trader. So we'll look at both those. So finance at Yahoo, let's look up a stock. Let's say we're going to look up a boring Xcel Energy, which is a utility company and energy stock, right? Based out of the United States, happens to be. And you can see Xcel Energy here and its price and all that. So if we looked at Xcel Energy, we'll go down here a little bit and you can see a quote for this. Investing.com would have a similar type quote setup, for example, or other services would have. And if we find the price to earnings ratio right here, remember, average is about 13 to 15. So being at 21.49, that's a real high price to earnings ratio, especially for a utility company. You might see tech companies that, or might even higher, like a Tesla would be higher, but that's pretty high for a utility company. By the way, where it says TTM, that's trailing 12 months, so that's kind of looking backwards as opposed to something that might be looking forward. Like down here where it says forward dividend yield, we're going to learn about that, but this pays a dividend. If it said NA, that means it wouldn't pay a dividend. Dividend is basically income for basically owning the stock. Also, if a company had no earnings, they were, let's say, losing money as far as having negative earnings, your price earnings ratio would say NA by. That's why when we look at price to sales, you might need to use that number. On Yahoo Finance, you can go under statistics here, and you'll find all sorts of other different types of measures. We'll be going through those later. Don't worry about that. But here's where you can find that PEG ratio, and you can see its current PEG ratio for Xcel is 3.11, right here, 3.11. So again, we are looking for something to be a good value as far as being a good price relative to its earnings and the growth of those earnings to be less than 1.0 in a PEG ratio. So that's, again, pretty high, especially for a utility company. So there's a couple negatives as far as why maybe it's not as good a value right now. Price to sales at 2.62. The average is about 1.62, ranging from 0.8 to 3.0 plus. So that's towards the high end here. So those are a couple things from a fundamental standpoint. We might say, oh, that might not be as attractive. let's look at it from a technical analysis standpoint, and we're going to look at this moving average crossover real quick. So I'm going to go back to this summary page, and I'm going to go to full screen, and then we're going to go up to TradingView real quickly after this to really look at it from a technical analysis standpoint, how that works, because you don't want to use the TradingView probably more for technical analysis. But Yahoo Finance is a nice free thing that's easy to do even technical analysis with. I'm going to click on full screen here to the right. It's going to bring up Xcel Energy in terms of a chart. You can see this is a line chart, so it shows how the prices are moving. You can see that we've got a downward movement here. This chart is basically based on an interval of a day. If you were, let's say, a day trader or somebody traded more frequently, you might be looking at 15 minutes or 30 minutes or 1 hour type things. Also, you can change the different types of charts. So we're going to learn about candlesticks, and that's a real informative thing, so don't worry about that right now. But if it's red, it means it closed down for the day. If it means it's green, it closed up for the day. So this is a candlestick. And you can see where we had this kind of this long trend back here where it's, a lot of down days, right? And then leveled off. So this moving average crossover, I'm going to just zoom in here. You can either use the plus or minus on Yahoo Finance. Oops, excuse me, on Yahoo Finance. Or I'm just scrolling with the mouse here, right? And we're going to take a quick look at. These bars along the bottom, by the way, are volume. So the taller the bar here, that means there's been more trading volume. So here you can see these days there's a lot of trading volume versus, let's say, these days, which have low trading volume. We're going to learn all about that. So for moving average crossover, which is a technical analysis indicator, we're going to go over here and we're going to look at indicators. And you'll have some commonly used ones. You can search for ones, but we're commonly used is the moving average. So we're going to choose that. This is a 50-day moving average. We'll leave it as a purple color here. And that's just basically the average prices. And you can see how it draws this new line across here, right? We have this new line. That's our moving average, our 50-day moving average. And how this indicator works is when a price goes above or below the line, that's an indicator of something. So if these are the prices, once it grows past that line, that's a sell signal. We're going to learn all about this kind of stuff in technical analysis, but right now, just think if it breaks a moving average line to the bottom, that's a sell signal that it's going to keep going past this moving average, and it has a tendency, nothing's perfect, but to keep going negative, to keep going below. And you can see it's not gone above the line. If it goes above the line, that can be a buy signal. If we look back here, you saw it went above the line. In this case, it was up for a little while, for a few days, maybe a week, and then went back down, crossed the line. Now it's more in sell territory. And this is the 50-day moving average, which is a longer time frame as far as moving average. If I added, let's say, another moving average on there, instead of being 50 days, the time period, let's say I want that to be a shorter time period, like 14 days. I'm going to change the color here to be more of an orangish color so it stands out a little bit. Just something simple like that. And now you can see where we've got this new moving average here and how this changes maybe our outlook from a more recent standpoint. See how now it's crossed above the line? That's an indicator that this might be a sell signal, but then we went back below the line. So we got a little bit of a whipsaw effect here, what's going above and below. We'll talk about whipsaws and all that later too. But you can see right now, if I was to look at this, I'd say there's some indecision here. Are we going to, I'm going to zoom in here a little bit. Am I going to, go, and I'm going to change this from a lot to a line chart here. And you can kind of see this blue line is the prices, where right now we're at a decision point. It's well below its 50-day moving average, but it's really approaching its 14-day moving average. So there's a chance that this might break through there, and that might be a sell signal, or excuse me, that might be a buy signal because it's going to break through and give you some momentum going more north or more positive. So that's the way simply for right now moving average. If it breaks through to the positive or to the top, that's a buy signal. If it breaks through the negative, that's a sell signal. And you can change by how long your moving average is. The longer your moving average is, you're using, the more how do I want to say it? The more likely that is a strong indicator. So if this is going above not only the 14-day, but also above the 50-day moving average, that'd be a very strong indicator. Let's look at one thing here. I'm going to go to TradingView real quick, because TradingView is where we can do our paper trading, is a good thing for free. Also, it's really much better for like that charting and the technical analysis, much more powerful. And they have a free version with ads. You can see my picture here, so I have a paid version, but let's use that. But if you get the free version, you're just going to get some ads. So I'm just going to click on here where it says Search Marketplace. You can go right under here, like markets, cryptocurrency, stocks, different things. I'm just going to click here for Search Markets. And then I can put in a stock I know. I can type out the name, like I could type in Apple, and it'll actually find Apple here and the different stock exchanges it's on here. I'm going to do something different. Let's look at Dr. Reddy's Labs. This is a company based out of India. They're a pharmaceutical company, do a lot of generic drugs is what they do. And you can see I just started typing in and they'll start coming up. Here's Dr. Reddy's Labs. And you can see here where where it says NSE, that's an India Stock Exchange. And you can see the little Indian flag there, of course. There's a New York Stock Exchange. It also trades on the New York Stock Exchange. So if I live here in the USA, I could buy it on the New York Stock Exchange. If I live in India, I could buy it on the NSE. And the nice thing about TradingView is also put in the currency based on the exchange you choose it from. So let's choose this one here. So we're going to choose India. And then this will come up in rupees, right? So you can see this is now INR, this is in rupees. So this is Indian currency in rupees for Dr. Reddy's Labs. If I click here, I can see it trades on a Berlin and a German exchange, some different exchanges here. It looks like Brazil there. I got the New York Stock Exchange, the US. So if I change the New York Stock Exchange, now I'm in USD or US dollars. Let's go back to rupees just for fun. All right, so here I am in rupees, and the thing is, it doesn't matter what currency it's in, the technical analysis will still all work, and same with the fundamental analysis too. So you can see it gives you a little chart here, but you want to go to a more advanced chart or whatever this square, they sometimes change the name here, full chart or see the best charts. You want to click on this square here, whatever it says. And now we see kind of a similar thing for Dr. Reddy's Labs, right? We've got our candlesticks, we've got a chart. I can scroll back and see what happened in time. I can change that chart from a day to, let's say, hours or minutes or seconds even, depending on what kind of trader you are. We're going to leave it at days. I can change it from those candlesticks, to maybe like a line chart, which will be good for, it makes it easier when we're looking for that moving average crossover. You can see here, just looking at this chart, what do you see here? This big drop here. So back in this date, they had an E for an earnings announcement. They pay a dividend too, that's the D part. So something must have went wrong with their earnings announcement. They had some bad earnings or something because it really dropped here and then it came back up and leveled off. So now let's look at a moving average against this and see what this looks like. So I'm going to go under indicators, that's a technical analysis indicator, versus let's say financials. I could go under financials and find things under statistics like my price to sales ratio or my price to earnings ratio or dividend things. I can type in here too to find something. So if I was looking for like PEG ratio, I could type in PEG and you'd find my PEG ratio for me. So you could use this exclusively. But let's go under here under indicators. And they got a ton of indicators. We're going to learn about a whole bunch of them, but they got a ton of indicators. So much better again for the charting technical analysis. I'm just going to start typing in moving average, and you can see I'll start coming up with that. I'll just choose moving average. There's different types of ones. So I'm just going to choose this basic moving average like we did before. Okay, so I chose that, and now it's put a moving average line here. It says MA9 here. That means it's a 9-day moving average. I can go here into my setup, and I can change what that looks like a little bit too. So instead of being blue like my other line, let's change that one to more of an orange, okay? And I'll click OK. And now you can see my moving average is that orange line. And so what do we see here? Going back in time, it kind of was whipsawing back and forth with this one. And then right here, earnings announcement comes out and it just blows right through the moving average line and just really plummets, right? And then it kind of bounces around here. So we would be looking at, well, what currently is happening, right? So it's below the moving average, it maybe is approaching it now, right? So we might watch this to see if we get a strong buy signal where it crosses above the moving average line. That would be a buy signal. If it keeps going below, that would be more of a sell signal. If we were a day trader, let's do that. Let's change it to 30-minute intervals. So this is a real tight type of interval, right? 30-minute intervals. And you can see, similar type things where it's going above and below. Here it's where day trader would say, okay, it broke through, maybe I want to buy this, and if it goes down, I want to sell it. So that's the way you can use, we'll go back to days here, that's the way you can use moving averages, but we're going to use a lot of other charting tools, and some of them are very easy like this, where it's just a matter of if it goes below, that's an indicator that's sell, and if it goes above, that's an indicator that might be a buy. And then we're going to learn other types of things too here where we can add on different types of stuff on here. So let's say maybe I'm looking at a longer term trend line. I'm going to draw a trend line here, and let's say I'm looking at like right here. I'm going to just sort of connect these tops here, right? And I could look at that and I could say, well, if this breaks through this trend line, that's also a buy indicator. So if I go above the moving average, I'm going to zoom in. If I go above the moving average coming up here and I go above that purple trend line, extending that out, let's say if that keeps going out for the next day, if that breaks through both these things coming up here, I might be watching that, and that would be an indicator telling me that this might be a buy opportunity. All right, so for all that, I just gave you a whole bunch of information real quick. Just use what you can right now. We're going to learn all about this and things like drawing trend lines and using moving averages. So it'll be real easy in the technical analysis section, and then we'll do the fundamental analysis too. So again, that's where you can start learning stuff. So take a look at tradingview.com as a place, and then also finance@yahoo.com are two spots where you can get started to look at a stock that might interest you for at least certain things to get you started, and then I'll get you started and we can keep going through the course. Or reminder too, on the Trading View, back down here under Trading Panel, you click on that and that'll bring up the paper trading where you can practice. Set up a paper trading account, they'll give you free money to use for practice for fun. So you can do that as well as a reminder. With that, we're on to the next lesson. So now we need to understand, how to kind of understand stocks and how to kind of speak the language and how to interpret some of this sometimes confusing numbers and things you might see out there. So we're going to look at stock quotes. So when somebody says, the Amazon is up 10% today, where are they getting that from and how to understand that and how to understand a stock quote. And we'll also look at a stock chart too, because I can kind of graphically show you how things are looking for a stock. We gave you a little preview with that one or a slide or two earlier. So stock quotes and stock charts may seem intimidating at first, but by the end of this lesson, they'll seem really, really easy, I promise you. And it helps you to kind of how you can look up some stocks. You can look up some stocks yourself that might interest you at the end of the lesson today that you can kind of do for homework. It's like, I'm going to show you examples, walk you right through it. And then you're like, well, I'm interested in this stock. You can now afterwards, after the lesson, be able to look it up and start comparing and really kind of get going right before we get into next day, day 2. All right, so let's look at stock quotes and how those work. So first off, you need a place to find the stock quotes. So I have many students from all over the world. So the easiest way is to look it up within your own country. So put in like stock quotes in India or UK or USA or wherever you live. Put that in and you'll start getting back things as far as different services that provide a stock quote. Now, two that are pretty worldwide and very universal and easy to use are Yahoo Finance and Investing.com. And how the quotes and charts and everything look are essentially the same. This one might be laid out a little differently. So I'm going to show you Yahoo Finance because it's really easy to use and it's globally as well too. So that's why I'm going to show you some stock quotes and some charts, and we're going to use Yahoo Finance, but you can use other ones too as well. There's many of them out there. So if you go to that finance@yahoo.com, at the very top of the screen, you'll see where it says search for news, symbols, or companies. And you just type in companies that are interesting to you. So if you're interested in Tesla or Amazon or Facebook or whomever, you just type in the company name and you'll pull down a list and you can just find it very easy. We're going to look at, for fun, we're going to look at two companies here, two very different companies. We're going to look at General Mills, which makes cereal, amongst other things. They make food products. So like yogurt, they actually are starting to really get involved in pet food, for example, but they're very famous for their cereals, known as Big G, or Big G brand cereals, like Cheerios and Wheaties, and one of my favorites, Lucky Charms. Not healthy, but I like them anyways. They've got marshmallows in them. So General Mills. And then we'll look at HubSpot, very different company. They're a customer relationship management software platform, very much oriented around like marketing and stuff. So if your company or a company needs to handle how to do social media marketing and organize all their different social media marketing, the software that can help do that is HubSpot. So they're more of a technology company. General Mills is more, of course, of a regular old food company, been around for a long time. So let's look at General Mills and HubSpot, and we'll look at their charts. We're going to look at their quotes first. So if you go to Yahoo Finance, you type in General Mills, this is what it'll come back with. All right, so at first you might be thinking, what is all this stuff? No worries, we're going to walk right through it, right? So I'm going to start in the upper left. You, of course, have the name General Mills. Where it says GIS, that's what's called a ticker symbol. So you can just, it's a kind of shorthand. So instead of like in Yahoo Finance to search for General Mills, I could put just GIS. And it's just a shorthand for that. Like Johnson & Johnson is J&J. Sometimes you even refer to that way. And then you see the big thing, which is the price. So 63.79. And you can see, it's up 0.3, and that equates to up 0.47 for the day. So for the day, this is how they're doing as far as in this particular day. So they're doing, pretty good, up 0.47 for the day. So that 6379, by the way, is the last price it's sold at. You may not pay that price. You may pay a little more, a little less, but that's the number they use for quotes and for charts and everything, is the last price it's sold at. And that, if you watch that, it'll constantly change almost every second throughout the day. So General Mills right now is trading or selling at 6379. If we go down well, and then in the middle, this is the summary, this is the quote, and then you can see you can get into other stuff like charts, conversations, some real deep statistics, profile will tell you what the company's about, that kind of stuff. Financials will show like income statements, but we're just going to look at the quote here. So if we look at this, we're going down the left-hand side now. It shows the previous close, right? So what did the end of the trading day, what did it close at? So it closed at 63.49. So we know it's up from there, right? At least as far as this time. It actually opened the day at 62.80. So that just tells you what was the first trade of the day. It was 62.80, and now the last trade when we took this screenshot was at 63.79. So it gives you a little information there. Now here's a couple confusing things. So what is this bid and ask price? What is that all about? So simply, bid price is the highest price a buyer is willing to pay, right? So right now, the highest price a buyer is willing to pay is $63.38. Now this changes constantly too. Our last price somebody paid $63.79. When you actually go on to buy it, it might be getting close to that $63.79, or it might be more closer to around the $63.38. They're constantly changing. And how many people are looking at that price as far as that bid price is the 1100. So highest price right now somebody's willing to pay is $63.38. Now the ask price is the lowest price a seller is willing to accept. And these are usually very close. This is, you can see it's $63.48. So about 10-cent difference between the two. So yeah, that difference is what's called the spread, by the way. Have you ever heard anybody say, oh, the spread? That's the difference. And the closer the numbers are together, the more easier transactions are. You don't have a wide spread, you have a narrow spread in this case. So you can see that it's easier to have a meeting of the minds somewhere in the middle, maybe at 63.40. It's constantly doing where you can actually go in and buy stock. But that gives the idea of the range it might be trading in at that exact moment in time. Then if we talk about ranges some more, you can see the range for the entire day. How is the day going as far as the lowest price to the highest price through the day? So you can see during the day it sold for $63.12. Somebody bought it at 63.12, and somebody paid $63.93 for it. Some human being actually bought it at this. And right now we're getting a quote of $63.79 would be the market price, or kind of the current price, or in fact the last price it's sold at. And that's in between those two. But it gives you an idea of the range. And then the same for the day. And then if you look at 52-week or the last year, it can show you a range. This is kind of helpful. Like, is the stock been up over the last year, or has it been is it more near the bottom of its range over the last year? And if we look at General Mills, 53.96 was the lowest to 66.14, so it's more closer to the high end right now. You'd be buying it near the high over the last 52 weeks. Volume is simply how many transactions there have been. So this is a pretty well traded big company stock, a large cap stock. You'll learn about that tomorrow, about market cap. And so there's been 189,000 transactions. This is early in the day, and you can see that's a lot of transactions. The average volume for the day, because we're early in the day when we took this quote, is a little over 4.4 million. So you can see we're early in the day, but we should average around 4.4 million. Some days are lighter, and some days are larger as far as the number of volume. The market cap, that shows you how big the company is in relation to other companies. So if you're comparing one company to another, the bigger that number, the bigger it's considered as far as in the stock market. Now tomorrow in day 2, we're going to go really into detail on market cap. So we're going to hold off on a couple things here, but we'll hold off on market cap till tomorrow. Now, beta is a measure of risk. All right, so you're wondering, oh, is General Mills a risky stock or a less risky stock? And there's many different ways to measure beta, or measure risk. And beta is one of the easiest ones, which is understanding how it compares to the wider market. And so and this is looking back over 5 years, looking at the monthly change in prices, basically up or down. How much up or down is it? And so what this number is telling us is how does it compare to the broader market? In this case, it would be like a broader, largest 500 USA stocks, right? The S&P 500. So how does it compare to that? So if it matched exactly those 500 stocks as far as going up and down in price, how risky or how volatile, it would have a beta of 1.0. So if it matches the market, it would be at 1.0. If it goes up higher, and let's say if you're at 1.0 for the market and the stock was at 1.0, then they're going to move up together, up and down. You'll see them essentially move up the same degree or percentage together, whether it's up day or down day. If, let's say, it's above 1.0, let's say the market's always at 1.0, and let's say my stock's at 1.1, right? So that means when the stock market goes up, the broader market, my stock's going to go up even more. In fact, by a factor of 0.10 or 10%. So when the market's up, then this is going to go up because it's up 1 point. That's at 1.0. By the same token, if we start level and the stock market's down, then this is going to go down further by that same amount, down that extra 0.10 basically. So numbers that are above or greater than 1.0 are more volatile, as in they'll go up when the market's up, but they'll also go down when the market's down faster, or bigger ranges, right? So you might see that with a lot of high beta technology stocks, for example, where they might go way up when the market's up, but when the market's down, they're really getting crushed. So General Mills, what was General Mills? That's 0.55. So it's kind of the same principle, just in reverse, right? So if it's going to go up, the market's going to go up. General Mills will not go up as far. It'll go up like 0.55. So it doesn't go as much as up on the upside. By the same token, if the market was down, let's say down, then General Mills is not going to go down as far either. So it has a narrower trading range up and down, which means it's basically less risky or less volatile. Less ups, less higher highs and less lower lows. It's kind of steering within a narrower range than, let's say, the wider range of the overall market. So if you like stocks, let's say, that are not as volatile or go widely up or widely down, then General Mills might be interesting to you because you're looking at that beta under 1.0. So to recap that, above 1.0, wider swings. Below 1.0, much less wider swings. In fact, 0.55 is a really low beta. So this is more of considered a very less risky as far as volatility, how much you go up and down stock. Okay, let's go back to our chart here. So if we look at this, now you're going to learn about some ratios. So we have a common one is the price to earnings ratio. And this is when it says TTM, that means trailing 12 months. So it's going back in time, looking at the price to earnings. And day 3, we're going to actually get in real detail on the price to earnings. Right now, to understand is it's a relation to what's the price I'm paying, the $63.79, for example, relative to the company's earnings. How is the company's earnings doing? Because earnings can be a real predictor of how the stock price will change. So a price earnings ratio averages right around 13 to 16, as far as price to earnings ratio for the whole market. It can vary by industry. So General Mills is right in there. But coming up on day 3, when we look at ratios and fundamental analysis, we're going to get in real detail on this. Just understand that when you're maybe looking at some stocks now, if it's above like 15, that's a higher price to earnings. You're paying more for those earnings, and you're paying more for that compared to a stock that has a lower price to earnings ratio. Basically, the lower the number, the better. But there's more to it than that, and we're going to learn about that. EPS is earnings per share. Same thing over the last 12 months. So for each share of stock a person would own, so if I want to buy 1 share of stock, I'd pay $63.79 to keep it simple. And I would pay, the earnings per share is $4.12. So that's good. They're profitable. They're making money, actually doing pretty good. Right? So that's $4.12 per share. Earnings date, you might see something in here where it's showing when the next time they're going to update their earnings. Usually that's done quarterly, of course. And you hear about somebody saying, oh, I've got the quarterly earnings is coming out, right? And they disclose how they did in the last quarter. So a lot of times you'll see a date as far as either the date where they've announced they're going to have an announcement around earnings, or it's going to be a range. Sometimes they'll show a range giving you an estimate when the next earnings announcement will come. Now, the next one to look at is dividend. Now, not all stocks pay a dividend, and we'll learn all about dividends in day 2 here. But this is looking at how much you earn as far as a dividend or income per share in the yield, kind of a percentage number. So for now, just think, the higher that number, that especially in the percentage, the 3.21, that's good, that's better. And again, not every company pays a dividend. Ex-dividend date simply means that if I own this stock by that date, then they're going to pay me money. They're going to pay me that dividend. Again, hold on, day 2 is coming. 24 hours, we'll get really into dividends. But understand that you can actually earn money just by owning the stock, and that's the dividend. And the dividend date, if it's listed there, they'll show an estimate of when the next dividend date. And then a lot of times they'll also show a one-year target estimate. That's kind of based on some, if stock market analysts or whatever, and they're compiling that together. So if we look at that, analysts are saying, okay, a year from now, they're anticipating it's going to be like $62.66. So that's kind of telling you that, like, well, wait a minute, General Mills is selling right now for $63.79. Why would I buy it? Well, you may not, at least based on analyst estimates. So the analysts are not right all the time. In fact, many times they're not right. So don't let that throw you, by the way. Just understand, especially if you're going to hold for a longer term than a year, you can just kind of look at that and kind of get an idea what they're looking at. And then to the right is the chart, right? So this is showing like a 6-month chart. And we're going to learn about charts coming up in just a moment. And we'll get into how to read a chart. But this just kind of shows how the prices have gone, in this case, over the last 6 months. And you can see that they've kind of gone down a little bit, and then they came kind of back up. So right now it's green, so they're up. So that's General Mills. We took some time to really go through, line by line on that stock quote chart. Let's do a quicker one with HubSpot. We'll go through that one quickly. And you can always rewatch this again to kind of get it all in together here. So if we look at HubSpot, you can see their ticker symbol is, yeah, that's right, it's Hub. Hubs, they're on the NASDAQ or New York Stock Exchange as well. Now you can see that their price is a lot higher, right? They are trading for $472.79. That doesn't mean it's a better stock, by the way. The price is sort of irrelevant that way. It doesn't mean, oh, I should buy it now because it's more expensive than General Mills. It's just showing what people are willing to pay for it right now. In fact, you can see it's down for the day. It's down 2.18%. And the previous close was at 483, and it opened at 486.55. So people are like, oh, let's keep buying this. But then it started coming down. Something has happened, or people are saying, oh, I want to get out of this, and it's coming down. You can see our bid and ask price is a little bit wider spread between the bid, how somebody's willing to pay, and the ask, the lowest price a seller is willing to accept. So you can see that's kind of going up there right now. It's a very interesting thing versus the last price was 472. The day range, I mean, look at that day range. We went from 471 to 480. That's kind of a good size range as far as in the day. And then if we look at the 52 weeks, right around 198 to 574. So it's really had quite a run up over the last year. So if you bought in around 200, 250, you've almost doubled your money. So great there. And you can see that their volume and their average volume is only 537,000 average volume. Remember, General Mills was like 4 million. So different type of stock, more of a smaller 22 billion market cap stock, versus General Mills, which was around 38 billion. Now we talked about beta. Remember we talked about beta where if it's above 1.0, it's going to go up higher, but if it's below, when the market goes down, it's going to go down further, so much more risky, right? So if we look at the beta of HubSpot, you can see they're at 1.71. So again, they're going to have higher highs and lower lows, in comparison to the market. So if you're looking for a safe, not real risky stock, well, General Mills might interest you. If you're looking for more of a growth stock, more of a tech type stock, then a beta 1.71, then HubSpot might interest you. Price to earnings, I wanted to show HubSpot because it's going to show a couple things here. So price to earnings, we're going to learn all about it again in day 3, but it's price basically divided by earnings. So if you don't have earnings, let's say you're losing money, then it'll show NA there, right? Not applicable because they're not making money. So that's why if you were looking up some stocks in your home on your own tonight, and you see NA, that's why they're showing they're not making money, at least over the last 12 months, in this case, trailing 12 months. And you can see that in earnings per share. How much have we made per share as far as the company has made in terms of income, revenue, or profit, really it's net profit. And you can see they've lost $1.99 per share. So that means the company that we're investing in is losing money. Now, many companies, especially technology companies or biotech companies and healthcare, a lot of companies lose money at the beginning, right? Because they're building their business. The early days of Amazon, for example, they lost tons of money. Tesla lost tons of money, but they were gaining market share, gaining, sales, and they were growing that company over time. And then when they started to turn a profit, then they started turning, big profits. You think about Amazon and the massive amounts of profits that they generate. But early on, they weren't generating those profits. So it's something to look at when you're looking at a stock chart. Will that company be able to turn it around and be able to, they're on the path to profitability, or are they really struggling and going down maybe even all the way to bankruptcy, which means we could lose our investment, or certainly our stock price would go down. So you can see here they're losing $1.99 per share. Same thing, you can have an earnings date in here. You can see dividend. What is forward would be what's the expected dividend coming up and what's that yield. And we're going to learn about that again tomorrow. So you can see that not all companies pay a dividend, and because it says NA here, HubSpot does not pay a dividend. HubSpot doesn't pay you to own the stock, income coming into you. So if you wanted to rely on some income coming from your stocks, General Mills would give you that, where HubSpot would not. We're going to learn about price appreciation and dividends coming up in day 2, where show you how to make money in stock either by the price going up or having some dividends coming to you, and or both. So hang tight on day 2. But that's something that you would look at and say, oh, if I'm looking at dividend stocks, then I'm not going to get that with HubSpot. And you can see there's no expected dividend date. You have to hold the stock by because it's not applicable because there's no dividend, right? And then again, 1-year target estimate, 608. So people are still very, what they would call bullish, versus to think the stock's going to go up, versus bearish, think the stock is going to go down, bulls and bears. And so with HubSpot, they say, well, okay, you're going to go up in price. And then again, we'll look at the chart here and you can see over the last 6 months that they're up over the last 6 months, like General Mills too. But with stocks, you can see there's lots of peaks and valleys, right? Ups and downs. So it's a lot more up and down volatile than maybe other investments like bonds and certainly cash. So while we're talking about charts, let's go now dive in quickly and we'll look at charts up here in this next part. So basically I clicked where it said full screen there, right in the upper right hand corner by where the chart is, and it brings up this full big chart. So let's take a look at the General Mills chart here, and we'll walk through how to read a stock chart because it can seem very confusing at first, but we'll walk you right through it. So again, this is General Mills. They make cereals, and on the left-hand side there, I'm just going to look at this top ribbon here. They have some things where you can kind of add in indicators. We'll learn about some indicators in day 3. Like if I want to look at a moving average and have that overlay over the chart, I'm going to show you exactly how to do that, for example. Or if I want to compare 2 stocks against each other, or compare General Mills versus a wider market index like the 500 large USA stocks like the S&P 500. Or if I want to compare HubSpot and General Mills together on the same chart, I can click comparison, enter in Hubs for HubSpot, or enter in HubSpot, and I'll show both on both charts. Shows upcoming events that are coming on here, and I'll show you that on the chart. And then you get to choose a date range. So where it says date range, you can click on that and actually put in specific dates. Most folks will just click on one of these preset dates here, and your range could be 1 day, 5 day, 1 month, 3 months, 6 months, year to date, 1 year, 2 year, 5 year, or however long the stock's been in existence. That would be max, right? And you can kind of click between them and that'll change your chart looking at the date range. You can see how it's highlighted there for 6M. So this is a chart for the last 6 months for General Mills. Next, you can choose your interval. So this is 1D or 1 day. So each one of those little marks that we're going to look at is a day. So each one of those like green, they're called candles, each green and red candle, each one of those represents a day below. I could change that to, if I was a day trader, for example, and I trade a lot during the day, I might change that to be more frequent, like maybe minutes or hours. Or I could change it if I was traded less, I could go to weeks or months. I can change that interval. Day is the real common way that it's used because we have, a trading day. So that's very common. The next, you can choose how the chart looks. These happen to be candles or candlesticks, which a candlestick, if we look at the chart now, shows if it's green, that means the closing for that day was up, right? So there's a wide trading range. You have the body of the candle, and then you have a wick at the top and the bottom, and that shows you the range of prices that a stock traded in on that particular day. If it's green, it means it ended the day up for the day from when it opened, and if it ends up red, that means it closed lower than it opened, right? So that's the idea between the green and the red. So think of green as an up day and red as a down day. And that's how these candles work. But I can change that look from candles to something like a smooth out line, for example, that might go on there, or tick marks. I can change the look of that. But candles is very common because they're very instructive as far as showing you open and closes and where some trends might be going. You have a drawing tool too, so if you want to draw some stuff on a chart, you can as well. So that's that top ribbon where I can kind of change my parameters. So I'm at 6 months on a daily interval, and we got some candles here. So now let's look at the chart itself. So how you would read a chart is it's basically time going from left to right. The further back in time is to the far left. So if I was to go 6 months back in time, because it's a 6-month chart, I would go all the way to the very far left. And then the current day, I would go to the very far right. That's the current day. And you can see how prices change just constantly through the day. By the time I took the screenshot, General Mills was at 63.72, versus whatever it was before. I think it was 63.79. Yep, 63.79. So you can see on the right-hand side there is prices. That's going from the bottom to the top is, a price range or high to low in terms of prices. So if we look at over the last 6 months, General Mills is trading anywhere from about, $53, dollars to up higher above 63.72. Got up, it looks like, closer to 68 or so. But right now it's trading at 63.72. So left to right is time, top to bottom is price. And thus, if we want our stocks to go up in price, we want to see them kind of going from left to right, from, diagonally, kind of from low prices to high prices over time. If we look at the actual chart here, and let's start at the far left, you can see how General Mills was kind of, drifting down, right? It had this little period where it drifted down. Then it had this big, like 3, 4, 5 days of downward trend here. It went just way down. See how those red candle bars went way down, kind of came back a little bit, then floated around, then went way back up, right? Went way back up, and then kind of drifted down again. And then we had this long, stretch of, where things are kind of going up, throughout the day, right? So they're going up, or excuse me, throughout the chart, they're going up. So, and you can see, and that eventually led us to our 63.72. So each one of these things is a day as far as what you see in the day. Again, green would mean that it's up from where it opened, and red would mean it's down from where the price opened. So now you might look at something that looks a little weird, like this part here, where it looks like it's gone up in price, and then the following day it goes down in price, but then the candle colors don't seem right. Well, what happened is, let's say with this first one, it went up as far as, it opened at a higher rate. So you can see it opened at really towards the top, but it closed down. So it closed and it down towards the bottom of that candle body. But the same token, where it went way down in that one day, like way down in price, but it now shows a small little green candle there. Basically what that's telling us is that it opened way down, but the end of the day up for the day. But you can see from the chart, they have this big gap down. It went way down. So that's just something to understand when you're looking through these prices. It's how it opens for that day and how it closes for that day. Now the lines along the bottom, a lot of times you'll see, is each of them is for that particular day, because we're looking at a daily chart. And this shows volume, how many transactions are happening. And sometimes volume can tell us, like, when there's something dramatic happening, where a lot of people are selling or a lot of people are buying, you can see there'll be spikes, right? And you can kind of see in those periods where there's been dramatic moves either up or down. Sometimes it goes way up or down in terms of volume. So that's what that's telling us. And then lastly here, you'll see where it says those Ds. Do you see the Ds there? That's just showing that there's a dividend. So when we were talking about how you get paid income for holding some stocks like General Mills, that means every time you see that D, that means they're paying out a dividend. So when we look at HubSpot, you can see they won't have the Ds. So let's take a quick look at HubSpot. You can see General Mills. Now let's look at HubSpot. So the same chart in terms of timing in my settings. So I've got 6 month, 1 day, and then I'm looking at candles. And you can see their wider price ranges throughout their chart. And you see that one part there where they have this big, what we would call a gap up, where it really jumped up in price. Where it jumped right here, and there's a lot of volume on that day too. So all of a sudden it just leapt right up to, ended up being over $500. where before it was trading like, I'm going to guess they're about 440, the day before. So quite a leap. So something happened. There was some news or something, maybe, something happened. The company announced where all of a sudden people got excited. You can see how the volume just leapt right up, and then the stock price jumped up too. And then as we look at that, further on from maybe that break point there where it gapped up, it drifted down, then back up, and then drifted down, and you can kind of see how HubSpot moved as far as they go. But the same concept of, if I'm looking whether at General Mills or HubSpot, the idea of reading these charts is exactly the same. In fact, a lot of people invest in stocks or trade in stocks just based on the charts, an idea called technical analysis or charting. So there's different ways to look at stocks. We talked about like price to earnings ratios and ratios, so we'll learn about that in addition to the charting part. So that's coming up, how to evaluate stocks. One thing that people struggle with sometimes is, what type of trader do I want to be? Which really gets down to, how often do I want to trade? Do I want to be a day trader, really trading every day, making little profits on many, many transactions or many trades, and almost that's kind of my job? Or do I want to be a little bit more part-time, a part-time trader? And there's all sorts of different types of traders in between, of course. Now, the good news is, if you've decided, great, and you feel comfortable with it, but if you haven't, or you can always decide later. You don't have to decide now. In fact, the course will really actually help you to determine what type of trader you want to be as you learn and go through the different types of lessons. When you start doing paper trading, for example, it's real helpful not only to help you practice what you're learning, but also to help you maybe decide what type of trader you want to be. And so you do paper trading, see what's working for you, and then when you actually start trading with real money and you get off paper trading, you start using real money, just start small, and then you can kind of develop those skills by starting small as well. So you don't have to decide that type of trading right now. And you can always change your mind. Maybe your circumstances change and you have more time to trade, so you want to trade more frequently than maybe you did in the past because things have changed in your life and you have some more time now. You can always change your mind. Now, when we look at trading and the types of trading, a lot of times it really gets down to time frames in terms of looking at things like stock charts and looking how often you're trading and all that. So they kind of go from like the scalper or arbitrage all the way up to like a buy and hold investor. And you can see the different types of things that are in between there. A scalper is like trading based on minutes and just small little minute changes and making tiny little profits each time, but doing lots of them to make big profits is the idea. Same thing with day trading, where you're trading throughout a day based on maybe minutes or hours looking at a chart, and you're making more trades. As you go up, or as you go through these bullet points, you're doing less trading, and you can see the time frames match that. Whether you're a swing trader or a position trader, you can see how that's different. Maybe you just want to be more of a part-time trader or investor, and every few weeks or months you might do some investing and some trading, all the way up to buy and hold, where you basically, it's less about active trading with buy and hold and more about more entries when you're buying with fewer exits in terms of when you're selling. So all these work. It's just a matter of what works for you, and then you want to apply it within that. I'll let you know that they kind of, sometimes some parts of the course will work better in other areas or for certain areas. All the stuff works. All the stuff is helpful. But some things like, if you're a scalper or a day trader, that technical analysis section, that charting section, that's real important because you don't have a lot of time to wait for dividends or earnings announcements. You're making more frequent trades. Or if you're more of a part-time investor or buy and hold investor, that's where the fundamental analysis might become, weigh a little bit more than, let's say, the technical analysis. If you think, Tesla is the company of the future and you don't care what it does going up and down, you just want to buy it and hold it for the next 20 years, the fundamentals will be important, less so than the timing around like the technical analysis or the charting. So the good news, you can use all the stuff from qualitative, looking at the vision and strategy of the company, to fundamental analysis and technical analysis, but certainly certain time frames match up even better. And really more so what we're talking about is that technical analysis part, going all the way up to the days and weeks, position trading, scalper, day trading, swing trading, position trading. Technical analysis becomes, very, very important. Even part-time trading, as far as intro, ins and outs using the technical analysis, and fundamentals are always there as well. So again, you don't have to decide what type of trader you want to be, but if you're thinking right now, oh boy, I really want to be a day trader, then really focus on that technical analysis section, for example, so as you go through the course. One thing that's often asked, and a real key consideration, is how many individual stocks should I own? How many should I have in my stock portion of my overall portfolio? Your overall portfolio might have some bonds, maybe some cryptocurrency, some cash, whatever. But the stock portion, how many individual stocks should I own? And the reason that's asked is if you have too few in terms of what you own, then you're not diversified in your stock portion or portfolio. If you only have one or two or three, you have a lot more downside risk. You might be investing like these 2 or 3 companies are the greatest in the history of the world, but it doesn't take much to all of a sudden have them be the worst companies in the history of the world. So that's one of the dangers of having too few. But the other part is if you have too many, then you could be over diversified, right? It's hard to track. You've got 40 or 50 stocks. How do you track that? How do you keep on top of what's going on with their strategy and their performance? So it's hard to track that. And there's less potential reward because you're so diverse and trying to manage that than versus something that you want to concentrate on more of your key bets, at least when it comes to individual stocks. So what's a good number? Well, let me share you some ideas around that. One, traditionally, what has always been in the literature for a long time is the traditional number was always 20 to 30 individual stocks. You want to get somewhere in that number range was always the historical norm as far as, what is the answer to that question, 20 to 30. Then there was a study done by Riley and Brown, and they found that portfolios that contain 12 to 18 stocks provide about 90% of the maximum benefit of diversification. So if you say, well, I want to get diversified, I want to own stocks in different industries and different things, you only might need 12 to 18 of them, that are in these different industries, and they can give you a lot of diversification, about 90% of it. And it makes it easier to track too. It also makes it easier to get started too, in terms of trying to buy 20 or 30 stocks. It's easier to start with 12 to 18. So I'm pretty comfortable with either that number or going higher to 20 to 30, by the way. And actually, when you start looking at another way as far as managing your money, a better way maybe to look at it is that in terms of diversification and reducing your risk, is a couple other things that have been used out there as well, particularly by more active traders who are trading frequently. And one would be that no individual stock is more than 5% of your total capital invested. So if you think about that, 5% would be 20 stocks, right? Of all this, of your total capital. If you had your total capital invested, 5%, that'd be 20. So for example, if you had $10,000 or rupees or euros or pounds, whatever you have invested, then you're looking at that, 500 per stock, right? So you have these smaller amounts per stock. You could even go smaller than that and say, okay, no holdings can be more than 2% of total capital invested, which gets you to 50, right? Now you got 50 different stocks because you've got, 200 units or $200 or whatever your unit is on a $10,000 investment thing, per stock. Now, if you had $100,000 invested, it'd be $2,000, right? So it's 2%. And this is particularly popular with more active traders where they're making lots of bets and some work out and some don't. And so protecting that downside risk, that 2% has been a real common number for more frequent traders. But 5% is fine too. You just get a little more downside risk. If you're more of a part-time trader or whatever, then getting that 12 to 18 or 20 to 30 is perfectly fine too. So any of these work, it's just a matter of what you're comfortable with as well. But I think that if you're frequently trading, then and especially if you're getting started out, it's better to have more stocks with less money in each as you're learning as well too. Start small, try to invest in more stocks. Take a look at lessons and thoughts around fractional shares, by the way. So if, in case you're wondering, well, how do I buy $3,000 worth of stock of Amazon or somebody? You can actually buy a small percentage of that. So take a look around things around fractional shares that brokers are starting to offer more than ever. And we have a lesson on that. Okay, so some final thoughts around that is you still want to, if you're holding 20 to 30 or 2%, whatever you're choosing, you want to diversify by sector and industry. That's the whole idea of getting that diversification, right? So if a sector would be like the big sectors like healthcare or energy or financials, and then the industry are like small sectors underneath that, small businesses or industries underneath that larger sector. So we have under healthcare, we have biotechnology, we have medical devices, we have pharmaceutical, and so on, right? So like what energy might be the sector, and oil and gas would be the industry as opposed to wind or something. And then a good thing is to have a variety of both between different types of sectors and industries, right? So you start looking at that industry level. So, You might have, let's say, some biotech companies, an electronic vehicle company, a larger technology overall sector type thing, banks, which is an industry of the financial sector. I mean, you have this mixture going on, and by doing that, you have a variety of types of investments. It helps kind of give you that diversification is the big idea around that. If you have 12 stocks and they're all in technology, you're diversified at the stock level, but you're not as diversified at the sector and industry level. So something to consider. Also, you can use ETFs or mutual funds for instant diversification. And maybe you want that to be your core holding, and then you add individual stocks around that. That's a common strategy, one that I've used myself, where I might have the S&P 500 largest U.S. stocks be my core holding, and then I buy individual stocks that I think are going to do well around that. But I might buy and hold that S&P 500 and just let that be at a low-cost ETF, for example, or mutual fund. But then I'm going to buy individual stocks, so I've got that little bit of diversification, and then I have my individual stocks around that. Even with that, the S&P 500 is only the largest stock, so I'm missing out in mid cap or small cap. So maybe in my individual stocks, I might want to target more small cap or mid cap, as an example. Or the S&P 500 is very technology heavy, so maybe my individual stocks might want to look more at healthcare or banking or some other industries. You can do it any way you want. It's just that you can use that ETF or mutual fund to help give you diversification as you're building out your individual stock portfolio. And that's the key thing in the end, is to do whatever is comfortable for you, right? So that's the key thing, whatever you're comfortable with and whatever you feel comfortable holding as far as the number of stocks and how you want to trade. In the end, it all is about you, and do what is comfortable for you. But there's some ideas around how many stocks should I own. Let's talk about how to choose an online stockbroker and some tips around that and what to look for when you're looking for your stockbroker that you want to work with. Now, there are still, full cost, expensive stockbrokers out there. There are certified financial planners and other types of advisors who can buy and sell stocks for you. They tend to be more costly, but they can give you maybe more direct advice. You're going to learn stuff in the course. You won't need to engage with them, but if you want to, you can. But you'll be able to just place your own trades as well. That's the goal of the course, so you can do all that and thus save a bundle of money. But if you want to use full-time people, you can do that too. And by the way, the tips that you're going to be in here, you really could apply both online or more face-to-face as well. But we're going to focus on how to pick an online stockbroker. So the first thing you want to do when you're searching is you want to make sure they're available in your country. That's the main thing. You could have people say, well, you should use ABC stockbroker. Well, if they're not available in your country, it doesn't matter. You can't use them. There's regulations around that. So you want to make sure they're in your country based on the regulations that they're regulated, and then also everything will be in your currency. You don't have to try to convert the currency, or anything will be in your local currency, whether that's rupees or euros or dollars or yen or whatever your currency is. So when you Google, let's say do a simple internet search, they'll come up with ones that are in your country, or otherwise you could put in online stockbrokers and then your country name, India, US, whatever it might be. So first thing is make sure that you're available in your country and that you can even use them. Next thing is you want to, and this goes all throughout, is the level of trust, right? Bigger companies with a lot of reviews online, things that you've heard of, there's a lot of trust around them. Like TD Ameritrade, eToro is popular with a lot of students. Interactive Brokers, are real popular internationally. Big mutual fund companies like Fidelity, Vanguard, Schwab. These are companies that have been around a long time, and they're really well-known companies and very established. So no matter what country you're in, look for something that's maybe big and established. In addition to the features and things we're going to talk about in a moment, but in the end, if you can't trust them, if you think they're maybe kind of a scam, if the word scam comes in your mind at all, you need to find a different broker. Don't even start with them, because it's all about trust. It's your money, so you got to trust them that they're not going to rip you off. Then think about, what type of investor are you? Are you, getting back to that, are you a real active trader, or are you more of a buy and hold trader? If you're a very, very active trader, then you want to go with a broker that's going to give you a lot of features around charting and technical analysis and things like that. If you're more buy and hold, then it's less important for that. Maybe you're looking for more things like education or ease of use or their mobile site or something like that. So, think about how you want to invest, and then when you're evaluating the company, then look for those things that you're looking for, that you're specifically looking for, that they're going to meet those needs. So think about what type of investor you are will help determine what type of broker works for you. And a lot of that comes back into the next thing, which is the user interface, right? Some are very simple, easy to do. You buy, you sell, that's about it. Maybe some confetti falls down when you make a sale, or you buy a stock, whatever. And others can be really complex with a lot of charts, a lot of technical analysis stuff, a lot of tools, and which can be overwhelming for some folks. So again, look at that user interface and decide, what works for you. As you go through the course, you're going to learn so much stuff, so you're going to be comfortable with pretty much anything, but in the end, it's still a personal decision as far as the user interface and what you feel comfortable using with. The other thing is look at what types of accounts are available. A lot of them are just, traditional brokerage accounts. I buy and sell a type of accounts, and it's with money that's already been taxed or whatever, it's after tax money. But some might offer like before tax accounts, like retirement accounts or savings types of accounts, where you can trade within a retirement account. In the United States, we would call that like an IRA, individual retirement account, type of thing, or 401k rollover. Those are just some of the type of accounts, and different countries have different types of accounts that might be more a retirement type account versus something that's not a retirement account. Even though you might be using it towards retirement, you might have some tax sheltering ability. So look for the type of accounts that the brokers offer, and does it meet your needs as far as where you want to, the way you want to have your money held in terms of the type of account. The other big thing is looking at fees. There's fees, could be account fees just for opening an account or holding a certain amount of money in an account, having minimums. Trading fees, are you paying a fee for each trade, each buy and sell? Are you paying a trading fee? Is there miscellaneous fees? Is there fees for like wire transfer monies or withdrawing your money before a certain time? Is there penalties around that? We're seeing a lot more of no fee, no transaction fee trading, by the way, which is great. In one respect, there's might have a little higher spreads, or there's some profit for the company behind the scenes, but it allows you to trade more frequently than if you're paying, $2 or $3 or more per trade. That's going to be much more limiting for you, whatever your currency is. So look at fees. It's very important. A lot of times you can test drive a free version of your brokerage account. Many of them are just free all the time, and they make their money on fees. But others might have a pay version or a pro version, where in addition you pay maybe a monthly amount in addition to other types of fees or other types of costs. So test drive the free version first, if they have that, to see how it's working for you. That user interface has got all the tools you want before you start paying for a pay version. And take a look too. It's well, what if I cancel my pay version? Am I locked in for a year, or can I just end it right away? That's the thing to look at. And then take a look at the analysis tools that are out there, both from a fundamental analysis, ratios, those types of things, PE ratios, all the dividend ratios, and then the technical analysis or charting stuff, from moving averages to candlesticks, all different types of tools that you can use to analyze. Again, as you go through the course, you're going to learn all these different analysis tools. You're going to have some that are going to be more popular for you, or going to work better for you because you like them better, and then you just want to make sure your broker provides those tools that you like. Good first step would be to really go through the course and then start looking at the broker ideally, but in between you can look at some lessons ahead of time and compare to what your broker might offer. Another big thing I'm real big on is paper trading. Do they have paper trading available where you can practice before you actually use real money? Many brokers, most brokers offer this because they want you to practice. They want you to practice on their site. So this is the other benefit of paper trading on a brokerage site, is you're actually using their tools, and you get to kind of test drive it before you start putting in your own money. So see if paper trading is available, so you can kind of give a test drive and practice while you're learning, but also learning on the brokerage site that might interest you. In addition is education. Some brokerage sites are very bare bones, don't give you anything, and some are very extensive in terms of education, and they'll really promote that. Now, you're going to learn a lot, of course, from this course. Maybe you'll take some other courses from me, which would be wonderful, would be great, but also your broker might be able to provide some education too. And are they providing education that's really only about how to use their site, which is nice and helpful, or are they providing education on other things that might be interesting, or blogs or other types of information that might be of interest to you and you might be used in your evaluation? And then, how easy is it to deposit and withdraw funds, right? Are they using the currency you want to use? Is it easy to move money in? Is it really easy to move money out? Sometimes it's easier to move the money in. It's a little harder to get it out. So look at those types of rules and things like how to deposit and withdraw funds, and what works, how that brokerage firm works, and whether it works for you. And then customer service. Some brokers firms are real famous for customer service and really, talk a lot about that when you hit their website. Others, not so much. And you can, look at things on the internet, and you can look at forums, or just Google search, your customer service for ABC broker, and you'll find all sorts of things. Now, do remember that, people are posting things on the internet are probably unhappy for some reason or another. So it may not be just that company. It may be this, they're unhappy and they're taking on the company because they made a bad trade. But if you start seeing things where like, I can't get my money out of this company, and you see that over and over and over again, then that's a little more scammy and something to be aware of. So customer service could be very, very important in terms of your brokerage thing. So those are some of the things to look at as far as when you're evaluating a broker. And again, you can always pick one, and you can always change your mind. That's the best part. It's best to make a good decision the first time, because then you don't have to change your mind. But if you have to, you can always get your money out and try a different one. Something that's a little newer in investing is fractional shares. And fractional shares are great. Fractional shares can be a great way to invest in companies that were really not available before to regular investors, because the cost of buying one individual share of stock was like over $3,000 or something for some of these companies. But fractional shares now allow you to invest in them as far as buying a fraction of that share, basically. Now there's some pitfalls to watch out for, and we're going to go through the pros and cons at the very end here, so you'll decide how you want to use fractional shares if you want to at all. So all that is coming up as far as what we're going to learn. So the big idea here is sometimes to buy one share stock, it can be very pricey. So fractional shares simply mean what they say. It's the first time in the finance industry, or one of the rare times when it's actually self-explanatory. You're buying a small portion or a fraction of a share. You're not buying $3,400 worth of Amazon one share. You're buying maybe 10% of that share, or $340, and you own only a tenth of Amazon, not one full share of Amazon. So this is where I believe we live in a golden age in terms of financial technology or fintech, where they give us using technology to give us some options here, right? So here we look in this example, a single share of Amazon, might cost $3,000, but you only have $1,000 to invest. Well, you can take, these 11 stocks that you see here, like Netflix, McDonald's, and Procter & Gamble, and all these, Nike, and including Amazon, and you can invest just a small portion in each one of your $1,000, and you can get a small portion of Amazon. So if you look at that Amazon on the left, if that whole circle is one share, you're just buying a tiny part of it, right? If we look at an example of that, how does that actually work in practice? This is from like Robinhood, actually. And you can choose, and not every broker offers this, but many are offering it more than ever now. So just be aware, not everyone offers it at this point. But you can choose to buy, in this case in dollars, or again, whatever your currency is, and you could invest as little as $1 to invest, or you could buy or choose to buy in shares and just enter a less than full share amount, right? So if you look at the image on the right, if you wanted to buy like a S&P 500 ETF, SPY is the name of it, you could start at $1, right? I could buy $1 on this particular brokerage site, Robinhood, or I could buy shares, and I could buy 0.000001, if I got that right. So you could buy this small, tiny part of the share without having to buy an entire share. So if we look at an example, let's say that stock ABC, I made up, sells for $500 US per share, right? You could buy one share at $500, right? Makes sense. If I wanted to buy half a share, well, it's half the price I'd pay, would be $250, and I have basically half a share. I don't have a full share, I have a half a share, $250. Or 0.25 would be $125, 0.1 would be $50, or I can even go as little as 0.01 and go down to $5 and buy a 0.01 of that share, of that stock, excuse me. It could go as low as $1 on this site. So as you can see, it allows you to buy these fractional shares at a smaller amount and then have a variety of shares, just smaller amounts of them. Now you might be thinking, well, what about dividends? What if I own a share of a stock of a company that pays a dividend and I get one dividend per share of stock? What happens there? Well, it's the same thing where you're getting a fractional dividend payout. So if I own one share, that equals to one dividend payout. Let's say on an annual basis, or let's say the dividend is going to pay me $2 or 2 units, right? So if I own one share, my dividend is 2, right? If I own a half a share, I'm not going to get 2, I'm going to get half of that. and I'm going to get 1, right? Because I own 0.5 of a share. So whatever you're getting in terms of your stock, in terms of what you would have for 1 share, you would get a lesser amount if you have a fractional share. In this example, 50% or 0.5. So it's a great way, again, to be able to invest in higher cost, higher price stocks and get some diversification by, looking at different types of companies. So let's look at those pros and cons. So there's some definite pros and cons. So as we mentioned, you get access to more stocks, basically higher price stocks. You can now access them. And it's very low cost to diversify, right? If I have a stock that sells for 1,000 and all I have is 1,000, I would only get 1 share, where now I could get 10 different companies for 100 each, right? 1/10. So you can get some low cost diversification. You have less money in cash, so you're more fully invested, which is a good thing if you're more fully invested, because I'm not waiting to build up my cash for that one time. Once I build up enough to now finally make that stock purchase of 1 share, I can be more fully invested with a lot of different stocks with fractional shares. And it works well for automated investing too. Let's say every month I send a certain amount to my broker, and I've decided I wanted to have an equal amount bought between these 10 different companies. They'll just automatically do it. I can make that all automated, and fractional shares work with that as well. So a lot of good pros there. Let's talk about some cons now of fractional shares. 1, fractional shares can encourage more active trading, right? I mean, that could be a good thing, it could be a bad thing, it all depends on you. If you're getting more fees and things, especially around if you're getting charged per trade, more active trading can incur more fees, which can incur your overall profitability. So something to watch for with that. Also, a lot of times with fractional shares, you have a very limited selection of assets. Maybe only certain stocks, maybe only large company stocks, or certain ETFs, or exchange traded funds, or certain types of cryptocurrency, but not all of them, as an example, maybe no crypto. So you might find that there's a limited selection of different types of assets or securities that you can invest in. We can reduce your liquidity in terms of how fractional shares trade. Shares trade in units of 1, and more commonly in units of what are called round lots of 100, right? That's typically how they trade. So if you have a fractional share, they have to, when the brokers is matching up, buyers and sellers, they got to kind of pull these different fractional shares together, to start, making it into 1 full share, and maybe up into 100 shares to start doing some of these transactions. So what that means is your fractional shares may not trade as fast or as quickly, or reduced liquidity is what all that means. They may not trade as fast as something that is more of full shares. They'll trade slower than full shares. And again, as we mentioned, not every broker offers fractional shares, so you can't enjoy the pros, let alone the cons, because they don't offer it. But something to watch for. More and more brokers are offering this because this is something that's being really driven by customer demand, because a lot of customers of theirs want this, and they'll leave for other brokers if they don't provide it. So you're seeing a lot more low costs on trading, you're seeing a lot more free type trading, and you're also seeing a lot more fractional shares, plus better support, plus better tools being offered by the brokerage sites as they all compete with each other. So there's some pros and cons in terms of fractional shares, and just be aware of that. And if you're already with a broker, go check it out, see if they offer it. If not, and this sounds interesting to you, keep going with the course, but you might want to start exploring companies that might offer fractional shares, brokers that might offer fractional shares, because that might be a great way for you to start getting in to some of these companies and some of these stocks with less money.